did you go to Canvas and click on the link? Period. That's all you should have to do, period. Oh, here's Catherine. Here we go. Here we go. There's Samantha. I saw Catherine before.
Hi.
Okay, now we can work here. Give it another moment. Did you have any trouble getting into this meeting?
No, the one in the email was asking for a password, but the one on Canvas wasn't.
Okay. Hold on one second here. One of our students I noticed popped up on the screen and now she's disappeared. And I just want to contact her back.
Yeah, no worries. Oh, I think she's back.
Here we go. I think this is Catherine. So we can get going here. Is that you, Catherine?
Yep.
Can you hear me?
Yeah.
You want to show your face, Catherine, or are you hiding on us?
I can show my face.
Here we go. Nice dog, by the way.
Thank you.
Labrador Retriever. Hi, Catherine. Here we go.
Hi.
Okay. Hi, Kate, Samantha. And we got the dinosaur going, huh? Okay. I thought we'd talk about the FSA a little bit. That's what Catherine was talking about, and Samantha. Catherine, what did you specifically want to ask me on that?
Because on Canvas it listed another template, but then the one that you sent us looked a little different, so I didn't know
Yeah,
which
the one I sent you, I never should have sent it in the form of an Excel file. That was a mistake, and I'm getting yelled at for that. Use the second one I gave you, okay? Because I added columns that we want you to show.
Okay.
Next to each year, the next column after that has the percentages, the component percentages.
Right.
So that's really the only real difference there. Okay? And the component percentages simply mean net sales is 100%, right? Net sales is 100%. Everything below net sales is a percentage of net sales, and that's how you get the number.
Okay.
Make a little sense, Catherine?
Yeah. So
you can do that. And then the time series, you know how to do the calculation. I showed you how to do that.
Mm-hmm.
But that's a suggested template. And then we need you to write up 2-3 pages after that now, right?
Mm-hmm.
You know, and hopefully you're all listening in here. Yeah, you know, you'd start by saying, you know, Kellogg's and General Mills are two big distributors of cereal, blah, blah, blah. Talk about some of their major products. Get a sense that we'll give you a little hint, one of the companies seems to sell more snooty products, more like designer coffees and things, and the other one's more basic snacks, okay? Look at the notes to the financial statements, especially when you get to the turnovers, AR. Look at the note on AR. They'll tell you some things. One of the companies offers a sales discount, and the other company I don't think does. And that might be something to look at, okay? So you think we got you going then, Catherine?
Yeah.
Okay, well, you can hit the bricks if you want. We're in a moment or two, we're gonna go into chapter 9, so you can stay with us or study on your own, whatever you like to do, okay? Okay, we got Kate here, Samantha. Samantha, what was your question on the FSA?
This is probably like a pretty stupid question, but I just am not sure where to find credit sales out of like
just use the net sales number there.
Just the net sales?
Yeah.
Okay.
Yeah, that's a question everybody asks. You know why they don't have too much in the real world in this business with returns and sales discounts and things? Because they're selling to big companies. You saw that 19% of, I believe, was Kellogg's sales are to Walmart.
Mm-hmm.
You know, Walmart, they buy exactly what they need when they need it. They're not glad to return things. So to answer your question, just use the sales number you see on both companies, okay?
Okay.
Were you all able to find the annual report?
Was I able to find it?
That's what you should be looking at.
I found it.
Yeah. You know, you Google the annual reports, okay?
And then I had one more question.
Sure.
For the percentage changes, like Oops, I like lost it. The percentage change starting with
The formula?
sorry. Is it normal for them to be like pretty small and negative, or did I do the math wrong?
Well, there could be. Those numbers I gave you were just made up numbers,
Okay.
on the
Okay.
template. Yeah, I mean, those are just examples. But yeah, it depends. Some companies are pretty steady, but look what's happening with the economy now. We're basically shut down, right? So when companies do their comparison this year to next year, yeah, you'll see some big negative numbers, big positive numbers, depending on what's going on, right?
Okay. Thank you. That helps a lot.
Okay, Samantha.
All right. Thank
All
you.
right.
Have a good one.
Oh, you're not sticking around for chapter 9, huh?
I have to get it done because I work for the next
You
few
go ahead.
minutes.
You go ahead.
Thanks. Bye.
Hi, Giovanni.
Hi, Bob.
Hey there. Okay, you're the man who can't show his face. You're afraid to show your
I promise soon I'll show my face.
face. Okay. All right. Hi, Kate. Okay. Did you want to talk about the FSA at all, Kate? Or
No, I'm good. Just
okay, you saw the
checking
new
in.
template I set out?
Yes, thank you so
Yeah,
much.
I
It's
just
very helpful.
added those 3 columns. And
Yeah.
I shouldn't, and I forgot I wasn't supposed to send it out as an Excel file, but it is what it is now. And
It's very helpful,
hopefully-
given how
it was
time
way too-
crunched.
it was much, it was much too helpful. It looks like we had some tough tests from some people. That was a pretty. What did you think of the test, Kate?
I honestly, I don't know how. I asked Cornelia for percentages, like the averages of the test, and apparently the average was like 79 or just almost 80. And I'm thinking, like, how are folks doing these calculations in such a quick time frame? I mean, you have 40 questions in 80 minutes. That's like 2 minutes on average per
Right.
question.
Right.
And each question takes, a long time to do. I did
Yeah.
prepare some templates
Yeah.
where I can just plug in the formulas so that I can do them quickly. But it was still like really hard to
Did you
complete
finish it, or you
No,
really?
I didn't. No.
Can I ask how many you got done?
So I probably got through about 2/3 of it.
Okay.
And then obviously then I just like guessed. I just was like, okay, I'm
Okay,
gonna go with
okay,
C
so
for this
some-
one because I had like a few minutes left and I don't want to leave any blank.
Okay. With that in mind, knowing what your score was, you did very well on the ones that you did apparently, and the time constraint. Okay, and you're doing okay. You've got a pretty darn good average going. So
I definitely I woke up the next morning and did some of the extra credit assignments.
As soon as I saw that, I said, "Good idea." What did you think of the test, Giovanni?
I think it was okay. I for some reason, for me, with the tests and quizzes so far, haven't been doing like that great. I do put a lot of time into the reading and all the homework time. One day I put like 10 hours into that stuff. But I mean, as long as I keep trying, and because I've done some calculations on like what I need to get.
Yep.
And I just stick to that and I should be fine.
Yeah, no, I know what your scores were. You're doing pretty good, and you know where you can find your grade at any time, right?
Yeah.
Yeah.
So is the trick to getting it all done is to make just Excel calculate formulas, like templates for everything? Is that the trick, or like?
Well, they can be helpful. Yeah, that's not the whole trick. You know what the trick is? When I took the CPA exam a long time ago, I took the prep course, from Becker CPA Review, and one of the things they emphasized was you're under time constraint, exactly like you were. Some questions can be answered in a split second. There are questions where you should be able to just look at it, where they say something like the gross sales were this and what were the net sales. That's a calculation perhaps you can do in 10 seconds. And then there's others that might take 2, like you say, 2-3 minutes. And it's just hard to get that rhythm
Oh
going.
yeah, of course. Some were, true or false and didn't require that much math. But then there were
Yeah,
others that if I didn't have those templates, it's like a
yeah,
page of calculations and like the
yeah,
LIFO
yeah,
and the FIFO and all of
yeah.
that.
Well, you
So,
should have done pretty good LIFO FIFO, right?
oh yeah, I think so. I don't think I've even looked at my like what I got right or wrong or if that's been released yet.
Yeah.
But
All right, you ready to go through chapter 9 a little bit?
let's do it.
Ready.
Now, okay. The first let me see here. Oop, let me get rid of this. Goodbye. Don't need that. Don't need this, I don't think. Okay, you still there?
Yep.
Okay. Chapter 9. Yeah, the first 5 weeks of this course was basically all of 110, where hopefully you learn to navigate debits and credits, and you know what the financial statements are and how they relate to each other. And then we started chapter 6. Intermediate accounting is what it really used to be called, okay? And we started in chapter 6 with the start of the balance sheet. We looked at cash and bank reconciliations, and we started off with the beginning of the income statement with the gross sales to net sales and the cost of goods sold. Chapters 9, 10, and 11 go together into one test. Chapter 9 and 10 are about what I'm going to call debt financing. Here in this chapter here, we're going to be buying things, big ticket items, and there are different ways to pay them. And we're going to introduce a concept which will confuse you all for a little while, and hopefully it'll click, and that's called present value. I don't know if you had a chance to look at the chapter yet. Present value. Present value. If you lend me $10 today, Kate, and I pay you back $10 in 10 years, did we have an equal exchange of value?
No.
How come? You're right.
Just the value of money changes. It
Exactly.
increases over time.
Absolutely. 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 $1 today is not going to be worth $1 10 years from now. So we're going to have to understand that concept like crazy in this chapter 9 and especially chapter 10 when we go to bonds. And by the way, this is kind of my favorite part of the course because for some reason I kind of like this stuff. But a lot of this we've already learned, and we're probably not going to go over too much. We know what a current liability is, right? Anything under 30 days. You're going to learn the accounts payable turnover, which is pretty easy. That's going to be our purchases divided by the average AP. Notes payable and the time value of money. Interest is what we're talking about. Now on the test, Kate, remember we were saying just now that there are certain questions you should be able to answer them pretty quickly. You're going to have a couple of questions on what's called contingent liabilities. There'll be no dollars in those questions. It's about the rules, okay? That type of thing. Working capital, we should know. We know what long-term is. And here we go. Present value, and apply the present value concept to different transactions, huh? Companies can raise money two ways, right? Debt or equity. Debt. We borrow money or we issue bonds to the world. Chapter 10 is all about the world of bonds. Companies raise money by issuing a bond. A bond is a debt. It's a note. It's an IOU. Coca-Cola says we're issuing a $10 million bond because we want to build a factory in Japan. The public has the opportunity to buy that bond and collect some interest, huh? The other way to raise money is going to be chapter 11, equity. You issue stock, okay? So in this chapter here, we're talking about debt. We're going to be borrowing money, and there are a lot of rules that make debts a little more dangerous than equity. If you borrow money, you have to pay it back. Who knew, huh? You don't pay it back, you can be forced into bankruptcy. If you don't pay people back, they can require you to sell your assets. So debt is a formal obligation. Equity is not, okay? Let me look at this. Defined is the probable future. Not going to look at that. This here, we've already learned most of this, okay? In fact, we really learned all of it. Accounts payable. That's your suppliers, right? The people we owe money to, accounts payable, are the suppliers, the vendors, the people with whom we do business. Accrued liabilities, that's that last week of the month payroll, where you work, but you're not getting paid till next month, and the company has to accrue it now. The electric bill, we have to estimate. Deferred revenues, that's your unearned revenue. And notes payable. You borrowed money from a bank or somebody, huh? You borrow money, it's a note payable, not accounts payable. And I'll let you look at this formula here. This is pretty easy, I think. Cost of goods sold divided by the average payables. Just like it was credit sales divided by average AR, just like it was cost of goods sold divided by the average inventory. Here, it's cost of goods sold divided by the average accounts payable. We are not going to do anything in this chapter with payroll taxes. Like I said, there's an entire course on that, and I'm going to skip that for now. Deferred revenues, here is our unearned revenue. The Starbucks cards, remember the gift certificates, Kate, people give you money in advance. That becomes a liability in terms of revenue. Okay, notes payable, here we go. Note payable. A note has an annual interest rate, and it has a lifetime. It has a beginning and an end, and it is an interest-bearing type of transaction. It's a legal obligation. It has rights over accounts payable. If a company is going out of business and they only have a certain amount of money, people who have a note receivable get paid before accounts receivable. So notes payable has advantages over accounts payable if you're the person who loaned the money. And remember, the principal times the interest rate is always the interest for a whole year. And I keep emphasizing that. So you're always going to have to consider if it's a 3-month note, 4 months. And here's a good example here, huh? Borrowed $100,000 times 12%. That's $12,000 a year, right? 100,000 times 0.12, 12,000. And they're only borrowing the money for 2 months, right, Kate? So you have to say to yourself, well, this is $12,000 per year, or $1,000 a month. So your interest is $2,000. A lot of the mistakes that are going to be made on the test, I can tell you now, Kate, are people are going to be multiplying 100,000 times 12 and ignoring the 2,000, which is probably answer A, and put down 12,000. Okay? Important to emphasize. Repaying debt, refinancing debt. You owe me money and you can't pay me now. I may let you refinance it. I may say, okay, I'll give you another 90 days to pay, but I'm raising the interest rate, huh? Long-term liability. I don't think this is much on the test. Now, hopefully you find this part interesting, and there'll be a couple of questions on this for sure on the test. A contingent liability. It's a potential liability created as a result of a past event. Contingent, you know that word contingent. I will lose weight contingent on going on a diet. You will get an A in this class contingent on working like crazy, right? Contingent. Something happening today that's going to cause something in the future. And you know what we're really talking about here, Kate? Lawsuits. When companies get sued. So here we go. There's some rules here. If somebody sues you, you as a company have a legal obligation to classify it under these three scenarios. One, somebody is suing us, and we sit down with our lawyers and our workers, management, and if we think that we will lose the lawsuit, if we think that we're probably going to lose the lawsuit, we have to record it as a liability right then, okay? For example, a potential customer came to show us his product, and one of our employees got mad and punched the guy. Obviously, we're going to lose that lawsuit, okay? So if we're being sued and we think we will lose that lawsuit, that's a liability. You debit legal expense or something, credit, lawsuits payable. If we're unsure, our lawyer says, I don't know, this could go either way. You do not put it into the financial statements, but you put it in the footnotes. The footnotes. So you're going to see a line item that's called contingent liabilities, or if there are no contingent liabilities, you're going to see a note anyway that there might be something to disclose. If it's remote, if somebody is suing us and it's totally frivolous and stupid and no reasonable person could possibly think this is a good lawsuit, we just ignore it. We don't even have to disclose it. So this is a good grid to look at, Kate, huh? On your homework, you'll get a problem which says a company was being sued because they were dumping lead into the water system, and the company didn't know they were doing it, and then they checked and they said, "Oh God, we're in trouble." That would be a lawsuit they're definitely going to lose. So you would record that as a liability. Otherwise, you would disclose. And the last thing, Kate, real quick, even if you're going to lose, if you can't put a dollar number on it, you have to just disclose it, okay? International perspective. We don't want to look at that, huh? You remember working capital? Current assets minus current liabilities. Current assets minus current liabilities. So if you have $1 million in assets, 300,000 in liabilities, your working capital is 700,000. That means that after you pay all of your liabilities, you still have 700,000 left over. It's called the working capital. It's money that is right there to handle current liabilities and other things if you need to. Changes in working capital are important to analysts because they have a direct impact on the cash flows from operating reported. Working capital has a significant impact on the health and property of a company. Wherever I work, we're always looking at working capital. Without working capital, you're really stuck. You don't have money to do anything operationally. You might be able to borrow money. You might be able to issue stock. You might be able to sell off a part of the business, but working capital only flows from operating. Why it's important. Liquidity, no questions on liquidity. The ability to pay current obligations, cash. Liquidity means cash, the ability to pay things. Cash is very liquid. It is liquid. Accounts receivable, quite liquid. Many working capital accounts have relationships to income producing. Well, we know this, right, Kate? Accounts receivable increases when sales are made in credit. We debit receivables, we credit sales. And on the other hand, if someone gives us credit, we debit purchases or whatever, and we credit accounts payable. That's going up. Changes in working capital accounts that are related to income must be considered when computing cash flows from operations. Let me take a look at this. When you borrow money, you might have to agree to what's called a secured loan. Collateral, you know the word collateral? Collateral. I come to you. You work at a bank, Kate, and I say, "Hi, Kate, I'm Bob. I have a little business. I'd like to borrow $10,000, please." And you check me out and you decide, I'm not going to loan this guy $10,000 unless I'm willing to give you something of value that protects you in case I don't pay you. Collateral. You know, you say to me, okay, Bob, I'll give you 10,000 right now, but hand me that Rolex watch I see on your wrist, and I'll put it in my drawer here. And when you pay me back, I'll give you back the watch. That's a secured debt. Secured. If you looked at me and trusted me, you'd loan me the 10,000. If it's an unsecured loan, you're asking for trouble. Long-term notes payable. Long-term notes payable. Well, if we need to borrow money, we can always borrow it from a bank, right? Insurance companies, we can go to one of our insurance companies, and they might help finance it. And pension plans, and this was abused like crazy. And there's a lot of laws now. You ever see The Godfather, the movie The Godfather? They financed, the true story about The Godfather is a lot of that financing of the big casinos back in the 50s after World War II were from raiding pension plans, the Teamsters. And that's just, the point is that's a way to raise money, but you better be able to pay it back, huh? We're going to be talking about like crazy is this method, issuing a bond. A bond. International again, huh? Okay. I'll go through this here, and you're not going to, this is not going to click right now. I know that. You're going to have to go to the book and study it a little bit and get the feel of what we're trying to do here. Lease. Lease is a rental of something, right? You can lease it, like we lease the copy machines we have in the accounting building, okay? So when a company leases something where they're going to have to make monthly payments, there are rules, very important rules, that delineate between what's called an operating lease or a capital lease. An operating lease is an expense, Katie. It's an expense. It's a short-term lease usually. An example of that would be we rent a copy machine from Xerox for 3 years. We pay them $400 a month, every month for 3 years. And then after 3 years, the lease is over and Xerox comes and removes their machine, okay? That's an expense, those monthly payments. But there are leases called capital leases, meaning they capitalize. They go on the balance sheet as an asset. And a capital lease meets one of these 4 criteria. And I'll just take you through it real brief. We rent a copy machine from Xerox for 5 years. And that machine really has a life of 5 years. Xerox and we agree it's a 5-year machine. Well, if we use it for 4 years, we've used it for 80% of its life. That means we can't call it an operating lease. It's not an expense. We have to debit lease asset or something. And this is, like I said, this is a little tricky here. I'll just take us through it here. If the deal with Xerox is this, Kate, at the end of the lease period, 3 years, if Xerox says, you can keep the machine, it's yours, that is a capital lease. And those monthly payments that we make, that is not an expense, okay? If the deal with Xerox is, after 4 years, 5 years, Xerox says, give me $100 and you can keep it. That makes it a capital lease. And you don't even know what this means yet. The present value of the lease payments equals a certain amount. So there's 2 areas here where on the test, if you learn the lease obligation world a little bit clearly, Kate, and the contingent liabilities, out of a 40-question test, that might be maybe 5 or 6 that you could do real quickly if you understand this, okay? There's a lot of numbers involved too, but on the test, I'm sure they're going to give you a description of a lease, and you have to be smart enough to know if it's an operating or capital lease. Contingent liability. Here we go, present value. And this is what's going to drive the students crazy for a while. Okay. $1,000 invested today. In 1 year, it's going to be worth $1,100, right? 1,000 times 10% is 100. You do that for 5 years, and in the future, you will have $1,610. This is the future value. This is the present value. The present value is what money is worth today. So, for example, if I offered you, if I say to you, give me, how do I want to express this here? If I promise to pay you $1,600 in 5 years, if you gave me, say, $1,200, that would be a good deal for you because the future value would be much higher. Let me see if I can make this more clear. A simple way to say it, let me say it more simply. Question, how much is the present value of $1,610 at 10% for 5 years? That'll be a question on the test. You get a lot of questions on tests like that. Kate, what is the present value of a single payment in 5 years, assuming 10% worth today? That's the present value. And here we
What would be
go.
the answer to that? Is it present value meaning?
What is this money worth today? In 5 years.
Got it. So you have to kind of work backwards to come
Yeah.
up with the fact
Now,
that
on
it
your,
would-
go ahead, I'm
that
sorry.
$1,000 were borrowed or whatever.
Yeah, invested, borrowed, whatever the transaction was.
Yeah.
Yeah. In other words, you, based on this interest assumption, $1,610 will be yours in 5 years. Okay? What if I came to you, Kate, and I said, I'll take that investment off your hands today. I'll give you $1,200 for it. Would you do it? You probably would, right? Because if 1,000 is worth $1,610, well, 1,200 is going to be worth more than that.
Yeah.
So you would take it from the guy. But if the person says, I'll give you 900 for this, you would tell them no, because that's obviously going to come out to a lower number, right? Make a little bit of sense?
Yeah.
Present value. It's what a dollar is worth today. It's the current value of an amount to be received in the future, discounted. Yeah, that's the term we used to use in school and where I worked. We always discounting, they called it. Future value. 99.9% of the calculations you're going to get in your homework and your test are going to be asking you to come up with the present value. I never ask any questions about future value because we kind of understand that. We know that $100 times 1.1 equals 110. If it was 2 years, it would be 110 times 1.1, etc. The trick is understanding how to get it back today so we can make a proper decision. Okay? How much do we need today to invest at 10% compounded annually if we need 1,003 years? Okay? Well, let's see how we're going to figure that out. How did we get that answer, Kate? I will show you, okay? Hold on. We got this from the present value table, which is an appendix in your book, okay? This chapter shows you how to do the formula, but you don't need to use the formula because the whole world uses the present value table, okay? So let's remember these two things. 10%, 3 years, right? 3 payments. 10%, 3 years. Let's go to the present value table. Can you read those numbers, Kate? They're too small.
Yep.
I just want to see something here. Okay, you say you can read it. Okay. It was 10% 3 years, right? 10%. So in this case here, it's a single number. In 3 years, you're going to get $1,000. So we go 3 years, 10%. Okay, we got to continue. 3 years, 10%. Can you read that number there? 0.7513, right?
Yeah.
How much are we receiving in 3 years, did we say? $1,000, right?
Yeah.
1,000 times 0.7513 is $751.30. That is the present value. That is the present value of this transaction. So let's look at this and think about it a little bit, huh? You need $1,000 in 3 years for whatever reason, okay? And the interest rate's 10%. We're just guessing on that, but 10%. You say to yourself, how much do I have to put in the bank today if I want $1,000 in future value? That's the amount there. Future value, present value. Future value multiplied by what's in the table will give you the present value. So a lot of this to get going, Kate, is how to use the two tables we need to use. Okay.
Okay.
Pretty intuitive, I think, so far, huh? It gets worse. And here they're just showing you, if you wanted to do it this way, 751 times 1.1, then that plus that, blah, blah, blah. Here, they're just showing you the trail. This 751.31 is the present value of this number, right? If they asked you for the present value after the first period, it would be that number. If they asked you for if they asked you for the future value here to get that, we get that, 1,000. With this investment, after year 1, you got that. After year 2, you got that, and then eventually hits 1,000, okay?
And is the interest the amount paid or like the compounded interest?
Yeah.
Okay.
Yeah. In this case, since in this example, I told you put the money in the bank. Yeah, that's the interest the bank has been giving you every year. And hopefully you didn't touch it, right? Because you want it to end up to go to 1,000. What we just learned real quickly as an introduction is what's called the present value of a single number. A single number. But companies often finance things where the deal is, I'll buy that tractor from you, and the deal is I'm going to pay you so much per month for the next 3 years. Okay? Here we have to go to a different table. We have to go to what's called an annuity. An annuity. It's a series of consecutive, equal, periodic payments. Could be monthly, could be half year, could be a year. An example is I collect a pension. That's a classic annuity. I get the same amount of money every month, for the rest of my life. An annuity. It's a series of payments. And there is a separate table for this. What is the present value of getting $1,000 each year? Now, in this transaction here, you have invested in something that's going to give you $1,000 at the end of the first year, $1,000 at the next year, $1,000 at the third year. Classic annuity. So the question is, how much money do you have to have now in order to make those 3 $1,000 payments? So again, it's 10%, 3 years. Let's go back to the tables. Okay, you see the table? Oh, for heaven's sake, Kate, I found it right here. So there we go. I knew there was a way to do that. Okay. Ah, boy, that's much better. Okay. This was the table we used just before, right? Because that investment only paid us one number at a point in time, a single number. The present value of an annuity has its own, an annuity has its own table. You'll see 3 tables here. Third one's for future value, which we're not going to use too much. Okay, present value of an annuity, huh? It was 10%, right? 10% for 3 years. I'm looking at 2.4869. You see that?
Oh, I see. Yep.
Okay. That tells me that's what $1 is worth today under those conditions. One of my favorite questions to put on a test, true, false, or I can do it multiple choice. Each one of these numbers equals how much money today? I know it's until it sinks in. Every one of these numbers equals what number today? You see that number? $1. That's what this table is. It's showing you what $1 present value is under these circumstances. If you borrow $25,000 at 5% for 5 years for 2%, you multiply 25,000 times that. Each one of these is $1, okay? So we just decided that it was a 3-year annuity at 10%, 2.4869. Let's see if that is the case, okay? Uh-oh, we're all hoping it's D now, right? 2.486. By the way, Kate, when you get your mark, and I'm sure you're going to get a good grade at this because it'll be a hard-earned grade, won't it? Okay. Present value of an annuity. 3 years, 10%. We go to the annuity table. So $1 under the scenario is $2.48685. We're borrowing 1,000. This is how much money we have to have now. If you put $2,486.85 in the bank today at 10%, at the end of the first year, you'll be able to make that $1,000 payment, and you'll be able to make the remaining 2 $1,000 payments. Okay? Confusing so far?
Very.
Yeah.
But I haven't read the chapter yet, so
Yeah,
it's.
yeah.
But I always remember, your
Yeah.
lecture and you going through it, and
Yeah.
when I read it, then I remember your words and it
Reinforce
clicks.
it, right?
Mhm.
Question is this. What is present value? What do you mean by present value?
How much is the money worth today?
Exactly. How much a future amount of money is worth today? How much money do you need today to reach a certain investment goal, right? Now we're going to see some applications of it. And I love this problem. I love this problem because it's a little tricky at first, but it really does pound this in. And we're going to go over this one a lot. I put this one on the test. I mean, if this was my class and we were in the classroom, you'd have to do the problem, is what I'm trying to say. Starbucks bought some new delivery trucks, and they signed a note agreeing to pay $200,000 on December 31st, 2017. Huh? The market interest rate is 12%. On 2/16, they bought a delivery trucks, and in 2 years, they have to pay $200,000. That's pretty clear so far, right? They don't have to pay anything for 2 years.
Yeah.
Okay. Well, guess what? Even though we're going to be paying 200,000, we cannot debit trucks today for 200,000. We cannot do that because we have to. Everything on our balance sheet has to be at the actual historical cost, which means we have to take that $200,000 and discount it back to its present value. So you go into your table for 12%, 12% for 2 years. Let's look at the table, okay? 200,000 is the future value. What is that worth today? How much money do we have to have in the bank today? 12%, 2 years. And I keep repeating that to myself because it's very easy to forget as you toggle back and forth. 12%, 2 years. We only have to pay one number, right? We have to pay $12,000 in 2 years at 12%. This is the annuity table, so don't make that mistake here. This thing is getting funky on me. Hold on. $12 2 years. We gotta go to the right table. Come on. Here we go. 12% 2 years. We see that, Kate? In 2 years, we have to make the payment, right? So that's the periods.
Yep.
2 years, 12%.
0.0972.
Yeah. What that means is
Or
that
0. Yeah.
yeah, that means that that money is worth $1 today. Okay. So let's go back 7972. We'll go back to the book. Can you see that now? Or
Mm-hmm.
okay, 200,000, right? Are you looking at the table or the problem or the PowerPoint now?
Your slides.
What I mean? The slide.
I'm looking at the
Okay,
slides.
okay, because I wasn't sure I did that right. Okay, 200,000. Here's our point 7972, right? They just used the fifth decimal. Here is the journal entry. Here is the journal entry. How about that? We debit delivery trucks or something, and we credit note payable. Because that is the present value. If Starbucks called us up today and said, wait a minute, I want you to pay me now the $200,000. Well, we would say to them, well, I'm not giving you 200,000 because the deal was I pay you in 2 years. I'll give you 159,438 if you want your money now. Making a little bit of sense?
Yeah.
A year goes by. A year goes by, and now we have to record the interest expense after 1 year. That makes sense. 159,438 times 12% is 19,133. At the end of the year, we debit interest expense for that amount. We credit notes payable. Questions on it?
No.
I'll bring your attention to something else on this page. How much was the note present value when we signed the deal? 159,438. That's how much we would have had to pay them back if they wanted their money then. If they wanted their money back after 1 year, the note has now gone from 159 plus this number to about 178.
So do you have to adjust the note payable every year?
Yes, yes, yes. It's not really an adjusting entry, but absolutely yes. That's the whole point. That's the whole point, especially when we get into Chapter 10 on the bonds. You're going to start out with a liability that is well below the number you're gonna have to pay at the end.
So
And these
somewhere in your books, you're going to have to make a note that this is due. This note payable is due at this actual amount, which is 200, and you've done the annuity calculation in order to
Yep.
come up with the 159,
Yeah,
and
this
remember
is
to adjust it. Okay.
Yeah, exactly. This is not an annuity, but yeah, you got the right idea. You go to the present value table for one number, 200,000. So now this note is worth up 159 plus 19. That's 178, 178. I don't know, 600 something. Now we go to the end of 17. We borrowed the money at the beginning of 16. Look at this interest now. The interest is higher in the second year. How come? How come? Because what was the present value at the time we borrowed the money?
159 for 438.
And what was the present value after a year? It was that plus that. So if you go into your calculator and you go 159, 438 plus 19133, you multiply it by 12%. That's your interest for the second year.
Where did you get the 19,133?
That was the interest for the first year.
Interest for the first year.
Okay. So now after the first year, that note payable has gone from 159, 438.
Plus the interest, plus the additional interest.
Yeah. You have a calculator in front of you?
Yep.
Let's add the three numbers together. Let's add how much we debited originally, the present value at the time of the deal, 159, 438, right?
Mm-hmm.
How much did we increase the note after the first year? Add that.
Yep.
And then add the 19,133 from the first year.
So I'm adding 159, 438 plus 19,133.
Plus.
And so why do I need to plus something else?
Because this is the interest for the second year.
Oh, I see.
So if you add 21429 to that, you should get a nice even number, huh?
159,438 plus 19.
Guess what number you will get? I have to Zoom at, I think, 3 o'clock with my family back east. This is always a...
No problem. I'm not sure how to do this.
Oh, okay, let's start again. No problem. What was the note payable when we signed the deal? 159, 438.
Mm-hmm.
Put that in your calculator. What was the interest for the first year? The year ending 31st, 16.
19,133.
Add that. And how much interest did we have to accrue here? 21,429. Add those three numbers up. And you should get $200,000.
So do I just go times 12%?
No. You don't do anything other than add. Another way I can show you. What was the note payable balance at the beginning? There's our present value at the beginning, 159, 438.
Yeah.
Now we add the 19,133.
Yep.
And now we add the 21429.
Oh, I see.
Just add those three numbers together and you should get $200,000. Might be off a dollar or so. Let me know if you get 200,000. If you don't, we got a big problem.
Yeah, it does.
Okay.
I got it.
It's like I said, this chapter here, chapter 9, 10, and then 11, when we get into stocks, it's a very tricky concept just to get the hang of it. But once you got the idea in your head what we're trying to accomplish, this chapter I think is interesting and very doable. Okay, the test you just took is by far the biggest in terms of how much was thrown at you. Okay.
Mm-hmm.
All right. So there we go. And then I guess we have one more entry to write, huh? Guess what we have to do after 2 years?
Remove the liability.
by paying the guy, right?
Hmm.
There you go. So that's one example of using a present value calculation, okay? Now, look at this. Starbucks bought some equipment. Starbucks bought some equipment again. But this time, the note is to be paid in 3 annual payments of the same amount. So this is not the present value of a single number, it's the present value of an annuity. An annuity, an equal stream of payments. So we're going to have to go to the annuity table. 3 years, 11%, right? 3 years, 11%. 3 years, 11%. 3 years, 11%. 3 years, 11%, okay? We want to go to the annuity table right here. Okay, here we go. 3 years, 11%. Oh, for heaven's sake. 3 years, 11%. 3 years. I see a number there. Do you?
Yep. One.
2.4437, right?
Yes.
2.4437. 2.4437. Let's go back to our problem. You tell me the answer to the problem. Use your calculator. How much is the annual payment?
In total or each?
Each. That's the whole point. That's a good question. I'm glad you asked that question. Yeah. When we go to the annuity table, all we're talking about is what the periodic payment is. In this case, it's once a year. So it's 163,685, right?
Yeah.
What was our conversion number we just found? 2 point what?
2.4437.
Multiply that out.
$399,997.
You think so? Yeah.
Slightly different, but yeah. I think I must have typed in the wrong
I'll
number.
tell you one of my goofy digressions here. When I first started tutoring, I was working with this chapter for the first time. And I kept getting wrong answers. And I couldn't understand why. I said, listen, guys, I know what I'm doing here. And some of them were complaining to Cornelia, you know? You know what the problem was, Kate? I was using a table that the students had with only 4 decimals. The book has 5. Makes a big, big difference, huh?
Mm,
Okay. So you're getting a little bit of the flair for that?
yeah, thank you.
So here we go.
I have a quick question.
Yeah, sure. Go right ahead.
So when it comes to like a problem like this,
Yeah.
we're not adding the interest every year. We're just directly multiplying the payments with the interest, correct?
Yeah, when you go to the annuity table, all you need to multiply, Giovanni, is what is the periodic payment. In this case here, it's 3 payments of the same amount, right, for 3 years. Yeah. So you go 163,685, like you see on the bottom here, times the conversion. You need 399,999 in the bank today, earning 11%, so that you can make these 3 payments.
Oh, okay.
So the 11% is just there to kind of throw you off. It's just saying that 163,685 already includes an 11% interest.
Yeah, it's going to account for it. Yeah, absolutely.
Yeah, okay.
All right.
But what if it says the payment is 163,685 and there's a principal interest of 11% on top of that? Then you have to.
Great question. Now you have a bond.
Okay.
Yeah. And we're going to get to that, I think, in the next example here. Yeah. Yeah. What if the deal is, look, I'll pay you $1,000 at the end of 4 years plus $5,000 a year. You'd have to go to
Okay.
the tables twice for those individual items.
Right, then it's not a note payable anymore then. Okay.
Yeah,
Alright.
yeah. So let's see what they're talking about. So here we go. We just showed you this, right? We came up with that. You came up with that, right? Kate, 399,999.
Yeah.
And here they're just showing you it again. So what would your journal entry be? What do we get a debit and credit? We're going to credit notes payable and debit lease, but for how much? Do-do-do-do-do. We're going to do it for that exact amount, 399,999. Question on that, Kate, Giovanni?
So for this type of problem, would it be like a way to say it is like backwards?
Yeah, that's another way to look at it. Have you been sitting here the whole class, or did you just pop in?
I've been sitting here the whole class. I just
Okay, yeah. All right, well, you heard me say, yeah, present value. This just means, present value means what a future amount is worth today. Okay, for example here, you need $399,999 in order to make these three payments, right? What if I came up to you and I said, I'll take this off your hands and I'll give you $450,000. Would you take it from me? Yeah, you probably would, right?
yeah.
Because obviously if 399 is worth, obviously if this computes to 399 on that basis, if I offered you that amount, you would take it. Otherwise, you know, would be wrong. Okay.
So can you go back for a second to the question? So go back to the slide that says, yeah, that's the one. So purchased equipment with a note payable to be paid off in 163. And each payment includes 11%. Okay, so you have to then include the value of the asset at its present value, which is 3.
Everything on your balance sheet is at its present value.
Present value.
Everything. You didn't know that yet, but when we, for example, remember we said when we buy inventory, it's at the present value, right?
Mhm.
I mean, it's at the historical cost. We bought
Yeah.
inventory. That's what that's what the cost is today. Here, these are future expenditures we need to discount. Giovanni, you used the expression going backwards, and that's exactly right. That's what we're doing. We're subtracting interest is really what we're doing. So we're good on, right now, if you guys walk away from this meeting comfortable using the table, that'll be a nice step in the right direction, okay?
Okay.
All right, so we know how to use the table. So we have to say, okay, we're gonna debit espresso machine, 399,999. And we multiplied that, we got that by multiplying the payment, okay? So here's the tricky part. Now here's where it gets a little harder.
Oh, it's just getting trickier and trickier.
Yes, yes. Okay. How much money are we paying each year? 163,685, right?
Yeah.
Okay. How much is the interest?
11%.
Go to your calculator, guys. What is 119? Now let me do it the easy way. How much? Do it the easy way. Cash. That's how much cash we gotta pay out, huh? What is 399,999 times point? Let me see. It was what was the interest on this again? 11?
Yeah.
Yeah.
Well, here it is. I just got myself blocked off. I just can't quite see the bottom of the page, but it should say something like you have a $399,000 note, right?
Yeah.
Times 11%. Is that what it says on the bottom? I can't see it.
Yeah, 44,000.
Okay. There, we got that number, huh? So how did we get the 119,685? I'm being a wise guy. How much was your total credit? 163,685, right? All we did was take the 163,685, subtract that debit of 44,000, and that's how much this liability was reduced after 1 year. I'll let you drink that in while I drink in my soda. What do you think, Giovanni?
I kind of understand it.
It's tricky. It really
Yeah.
is. Yeah. And it gets really tricky in the next chapter. So, we get, well, once you get these little fundamentals down, it's makes a big difference.
Yeah.
Yeah, we'll start again here, huh? You're being introduced to an annuity here. An annuity, an equal payment for 3 years, 163,685. 3 years, 11% told us that $1 is worth 2.44371. We multiply it by the annual payment. That's how much we owe right now at the present value. If this company said to Starbucks, we've changed our mind, we want our $999 now, we don't have to pay the present value of it, okay? So let's take a look. We know where that came from now, right?
Yeah.
That's the principal. That's how much we owe. But that principal is going to go down every month when we make the cash payment. So we're going to credit cash for 163,685, the number they gave us in the first place. We multiply that by 11%, we get 44,000. The difference between the two is the reduction of the note after 1 year. So now, Giovanni, Kate, we started with 399,999 credit, and we reduced it by this amount. So the next year, the interest would be, they're not continuing the problem, but let's do it together, okay? Note payable. You have your calculators going, guys? 399,999. Multiply that by 11%, and you got the 44,000, right? We know that.
Yeah.
Okay. The note was, go clear your calculators, 399,999 minus 119,685.
I got 280,314.
Yeah.
Okay. Multiply that by 0.11.
834.
Yeah. They're not continuing the problem. So the next year, you would still have this 163, right?
Yeah.
And you would have 30, what do you say, 30,000 something?
Yeah.
Yeah.
The difference between those two numbers is going to be the reduction for that year.
So for this, in this case, if we continue the problem, since we reduced the amount from the 3,999,
Yep.
Our interest in this case got lowered because there's less to start with.
Exactly right. It's getting lower and lower because we're reducing the present value with this note. This was the present value when we made the deal. 399,999 minus 119,685 gives you the present value for the second year. Yes, the interest is going to go down every year. And then if we did it for the third year and you debited note payable, the three payments will equal the 399,999. Tricky. All right, Kate, I think we're getting to the end here. If this is what you asked about before, you said, what if there's an investment with a principal and an annuity? Well, here it is. This is a bond. They're not telling you it's a bond yet because you're not supposed to know it. But Starbucks bought roasting equipment, and they agree to pay $1,000 a month for 20 months, okay? And at the end of 20 months, they're going to pay him $40,000 on top of that. Wow. The interest is 12% a year. 12% a year. Wow. We have to go to the table, each of the two tables. Step one, compute the annuity. Compute the annuity. We go to the table and we went 20 periods, 1%. Where did they get the 1%? It's 12% a year, but we're paying it every month. So it's 1%. So that'd be 1% for 20 periods. And I'd like to show you the conversion again. 1%, 20 years.
It's at 20 months.
20 months, I'm sorry. I'm glad you corrected me, because the proper term really is payments. It could be a year, it could be a month. Go ahead, Kate, I'm sorry.
Yeah, no, that's just what I was confusing me in terms of like how to figure out this problem.
Yeah, like I said, whenever you see an interest rate, it represents a year. So in this case here, it was 1% for, see, I'm just having trouble navigating with this thing. Hold on. 1% for 20 periods. 1%. Oh, look at this. I remember this now. They don't have 1% in our book. It starts at 2%. So we'll have to trust them that the number is 18 point something, okay? Another little clunker here from our buddies at McGraw-Hill. Okay. The annuity. This is how much we have to have in the bank now if we're going to pay $1,000 a month for 20 months. In other words, we're going to be paying $1,000 20 times. So over 20 years, we're going to be paying them $20,000. Here's how much we have to have now if we're going to meet that goal. The annuity portion. The annuity portion. But there's another part to this. And the rest of the deal is at the end of 20 months, we're going to hand them $40,000. So we would go back to the table. We don't have 1%, but if we went 1% for 20 periods, that would be the conversion. So this investment here, the present value of this investment at the beginning is $18,000 for the annuity, 32 for the single payment at 40,000. And there's your total investment at present value. Comments, Kate, Giovanni? Our class is mostly business majors, right? People are going to go into marketing, accounting, sales, or management, entrepreneurships and stuff like that. This is the type of thing you're going to be doing all the time, huh? Giovanni, 10 years from now, you might be running a division of a company or working somewhere. And the boss said, okay, we got to go out and we got to buy a new building in Kansas City. We got to set up an office in Kansas City, Missouri. Giovanni, how do we do it? And you would go around to banks, you would talk to banks and investing companies, and you'd figure out the best way to finance it. You might decide you're going to pay cash now, if you can do that, or do it with an annuity, do it with a single payment, or a combination. And don't worry about this point, believe me, and deferred taxes. So that's the end of kind of a gruesome chapter, huh? When you first see it, you start doing the homework problems, and it'll click a little more. You're both good with the FSA, huh?
I am just about to tackle it, so.
Yeah. Yeah, I thought we would get more people here today just to talk about it, but I was going to just talk a little bit about your write-up. Start by describing each of the two companies, what they do, blah blah blah. It's a good place to start. Look at the beginning of the annual report. It's called the management's letter, or the letter from the president. That's where they brag about the company and try to put a good spin on things. That's where you get some information. And then, like I say, and then address the component percentages. One company has much higher percentage of cost of goods sold, but the other company has better results with operating expenses. And maybe look at the notes and find why. Do the same thing with the time series. You'll notice that both, I haven't looked yet, but I believe both companies are showing very small growth in their serial. And maybe they took measures to reduce cost of goods sold or something. You can talk about that. And then the same thing with the AR turnover and the inventory turnover. Okay.
All right.
You could write 100 pages if you wanted to on that. We're looking for maybe 3 good ones. Okay.
Great.
All right. Anything else I can do for you?
I have a quick question on the FSA.
Yes.
So I was working on it yesterday, and I just have to write the 3 pages.
Yeah.
But I wasn't sure on the average inventory, because you know how eventually we had to use it for a calculation.
Yeah.
For that, do you just end up getting the inventory? Because I don't know who it was. I think it was like General Mills that had it labeled as inventory, but it asks you to get the inventory from the beginning and at the end of the, I think it was the year or the period. So would you get the inventory from 18 to 19?
Yeah, exactly.
Yeah. Okay. And then you just divide that after you add them, right?
Yeah,
And
divide by 2, and that. Yeah, exactly. Divide by 2, and that's your average inventory. Do the same thing with receivables for that portion.
Okay.
Yeah. And I don't think there's any, and the sales, just use the sales that they present. We'll call them we'll call those net sales. Okay.
Yeah. Yesterday I took a little longer. I was like, why can't I find it? And then eventually I was like, it's just net sales.
Yeah. That's part of the journey, huh? Yeah. My boss, like I said, she's fuming because I accidentally, stupidly sent out the Excel version of the template. But you still have to understand it and do it, right?
Yeah.
Yeah.
Okay. And those were fake numbers I put in there, obviously, right?
Yeah.
Yeah.
I had a couple students when I first started turn the exact numbers that I gave them in the example back to me. And they had all kinds of good comments, but it was a fictitious company, So, all right. I guess it's time to call it a day, huh?
Thank you very much.
All right. Remember the friendly raccoon wave. Bye, everybody.
Bye.
Bye.
Bye now. See you later.